Let me tell you something that changed my entire understanding of wealth when I was young, and it had nothing to do with stock tips or market timing or any of the things most people obsess over today. It was a simple realization, really. So simple that most people dismiss it entirely. The secret to turning $1,000 into $100,000 is not a secret at all. It is math, patience, and the discipline to get out of your own way. That is it. No complexity, no magic formula, just the quiet, relentless power of compounding applied over time with unwavering consistency. Now, I know that title might have caught your attention because it sounds almost too good to be true. And in a world filled with people promising overnight riches and get-rich-quick schemes, I understand your skepticism. You should be skeptical. But what I am about to share with you is not a scheme. It is the most fundamental truth about building wealth that has ever existed, and it has worked for over a century. It worked for me, it worked for Charlie, it worked for anyone who has ever had the patience to let time do the heavy lifting. Let me explain something most people misunderstand about money. They think wealth is created through brilliance, through finding that one perfect investment, through timing the market at exactly the right moment. They spend their lives searching for shortcuts, and in doing so, they miss the single most powerful force available to any investor, regardless of their starting point. That force is compounding. Albert Einstein reportedly called it the eighth wonder of the world, and whether or not he actually said that, the sentiment is undeniably true. Compounding is the process by which your money earns returns, and then those returns earn returns, and then those returns earn even more returns. It sounds simple because it is simple, but the results given enough time are anything but ordinary. Consider this. If you invest $1,000 today and earn a 10% annual return, after 1 year you have $1,100. Not very exciting, I admit, but here is where it gets interesting. In year 2, you earn 10% not on your original $1,000, but on your new total of $1,100. That gives you $1,210. The extra $10 might seem trivial, but it is the beginning of something profound. By year 10, your $1,000 has become $2,594. By year 20, it has grown to $6,727. By year 30, you are looking at $17,449. And by year 49, that original $1,000 has crossed the $100,000 threshold. $1,000, no additional contributions, just time and a reasonable rate of return. Now, I can already hear what some of you are thinking. 49 years is a long time. And you are right. It is a long time. But here is what I want you to understand. Most people will live 49 more years from some point in their lives. The question is not whether you have the time. The question is whether you have the patience. And patience, my friends, is the rarest commodity in investing. It is far rarer than intelligence, far rarer than information, far rarer than capital itself. The ability to sit still and let compounding work is what separates those who build lasting wealth from those who spend their lives chasing it. Let me share a story that illustrates this perfectly. When I was young, I read a book about compound interest, and it contained a tale about a man who offered a king a choice. The man had done the king a great service, and the king offered him any reward he desired. The man pointed to a chessboard and made what seemed like a modest request. He asked for 1 grain of rice on the first square, 2 grains on the second, 4 on the third, and so on, doubling with each square until all 64 squares were filled. The king laughed at what he thought was a foolish request and agreed immediately. But by the time they reached the 64th square, the amount of rice owed was more than had ever been produced in the entire history of the world. That is the power of compounding. It starts slowly, almost imperceptibly, but given enough time, it becomes unstoppable. The market over time has delivered returns that make this kind of growth not just possible, but probable. Over the past century, the stock market has returned roughly 10% annually on average. There have been years of 20% gains and years of 30% losses. There have been crashes and booms and everything in between. But through it all, for those who stayed invested, for those who did not panic, for those who understood that the market is there to serve them and not to instruct them, the long-term trajectory has been unmistakably upward. This brings me to an important point about how most people fail at investing. They fail not because they lack intelligence. They fail not because they lack information. In fact, we live in an age of more information than any generation before us. They fail because they cannot control their emotions. They buy when prices are high because everyone else is buying and they feel left out. They sell when prices are low because everyone else is selling and they feel afraid. They do exactly the opposite of what they should do, and they do it consistently over and over again throughout their investing lives. I have often said that the stock market is a device for transferring money from the impatient to the patient, and I mean that quite literally. Every time someone panics and sells at the bottom, someone else is buying. Every time someone chases a hot stock at the top, someone else is selling. The patient investors, the ones who understand what they own and why they own it, are on the receiving end of these transfers. They are not smarter in any technical sense. They simply have the temperament to stay calm when others cannot. Let me explain something about market volatility that most people get completely wrong. They see a stock drop 20% and they think something terrible has happened. They see the news. They read the headlines. They feel the fear in their stomach and they sell. But here is what they miss. Volatility is not the same as risk. Volatility is simply the price fluctuating in the short term. Risk is the permanent loss of capital. These are two entirely different things. A wonderful business that drops 20% in price because of temporary market panic is not more risky. It is actually less risky because you can now buy it for less. But most people cannot see this. Their emotions blind them to the opportunity. Think about it this way. If you owned a farm and your neighbor came by every day offering to buy it or sell you his farm at different prices, you would not make your farming decisions based on his daily mood swings. If he offered you half of what the farm was worth, you would not suddenly think your farm had become worthless. You would recognize that he was being irrational and either ignore him or take advantage of his mistake. The stock market works exactly the same way. Mr. Market, as my mentor Benjamin Graham called him, shows up every day with a different price. Some days he is euphoric and offers you ridiculous amounts for your shares. Other days he is depressed and will sell you wonderful businesses for a fraction of their true value. Your job as an investor is not to follow his moods. Your job is to take advantage of them. This is why I have always emphasized the importance of thinking like an owner rather than a trader. When you buy a stock, you are not buying a ticker symbol. You are not buying a line on a chart. You are buying a piece of a real business with real assets, real employees, real products, and real earnings. If you would not be comfortable owning that business for 10 years without ever seeing a stock quote, you should not own it for 10 minutes. This shift in perspective from trader to owner, from speculator to investor, is perhaps the most important mental shift you can make. Now, you might be wondering how to find businesses worth owning for the long term. And this is where I want to share some principles that have guided me throughout my career. First, look for businesses you understand. I have said this many times, but it bears repeating. Stay within your circle of competence. You do not need to understand every business in the world. You just need to understand a few of them really well. If you cannot explain what a company does and how it makes money in simple terms, move on. There are thousands of other opportunities. Second, look for businesses with durable competitive advantages. Charlie and I call this the moat. Just like a castle with a moat is harder to attack, a business with a competitive advantage is harder for competitors to displace. This might come from a strong brand, from network effects, from cost advantages, from switching costs, or from any number of sources. The key is that the advantage must be durable. It must be something that will still be there in 10 or 20 years. Many businesses have temporary advantages that erode over time. Those are not what you want to own. Third, look for businesses run by honest and capable managers. The best business model in the world can be destroyed by incompetent or dishonest management. You want managers who think like owners, who allocate capital wisely, who communicate honestly with shareholders, and who have integrity that goes beyond just following the rules. This is harder to evaluate than financial metrics, but it is equally important. Fourth, and this is crucial, pay a reasonable price. Even the best business in the world becomes a bad investment if you pay too much for it. This does not mean you need to find bargains everywhere. Wonderful businesses are worth paying up for, but you still need to be sensible about valuation. The higher the price you pay, the lower your future returns will be. This is simple mathematics, and no amount of optimism can change it. Let me share some historical perspective that I think is valuable here. Throughout my lifetime, I have seen markets go through incredible cycles. I remember the crash of 1974 when stocks fell nearly 50% and everyone thought the world was ending. I remember the crash of 1987 when the market dropped over 20% in a single day. I remember the dot-com bubble of 2000 when companies with no earnings and no prospects were trading at astronomical valuations. I remember the financial crisis of 2008 when the entire banking system nearly collapsed. And more recently, I remember the swift crash of 2020 when a global pandemic brought the economy to a standstill. In every single one of these periods, there were voices saying this time it was different. This time the market would not recover. This time the old rules no longer applied. And every single time those voices were wrong. The market recovered. The economy adapted. The businesses that were truly excellent continued to grow and create value. The investors who stayed calm, who stayed invested, who took advantage of lower prices to buy more, ended up far ahead of those who panicked. This is not to say that every investment works out. Some businesses do fail. Some industries do get disrupted. That is why diversification matters and why you should never bet everything on a single outcome. But the overall trajectory of human progress, of innovation, of wealth creation has been consistently upward. Betting against that long-term trend has been a losing proposition throughout all of recorded history. Now, I want to address something that I think holds many people back from building real wealth. It is the belief that they need to be rich to start investing, that they need thousands or tens of thousands of dollars before it makes any difference. This could not be further from the truth. The mathematics of compounding do not care about your starting point. Whether you start with $1,000 or $100,000, the percentage growth is the same. And time, which is available to everyone regardless of their current wealth, is the most powerful variable in the equation. If you are young and starting with little, you actually have an enormous advantage that no amount of money can buy. You have time. A 20-year-old with $1,000 has nearly 50 years of compounding ahead of them before a typical retirement age. A 50-year-old with $100,000 has only 15 or 20 years. In many scenarios, the 20-year-old will end up wealthier, not because they started with more, but because they started earlier. Time is the great equalizer. It is the asset that cannot be purchased at any price. This is why I encourage young people especially to start investing as early as possible. Even small amounts invested consistently over time can grow into substantial sums. The habits you build in your 20s, the discipline of saving and investing, of living below your means, of thinking long term, these habits will serve you for the rest of your life. And the earlier you start, the more time compounding has to work its magic. Let me share one more analogy that I think captures the essence of what I am trying to communicate. Imagine you plant an oak tree. In the first year, it grows only a few inches. You can barely see any progress. In the second year, it grows a little more, but it still looks like a twig. After 5 years, it is still a small tree, easily overlooked. But after 20 years, it has become something substantial. And after 50 years, it is a magnificent oak that towers over the landscape, providing shade and shelter and beauty. The growth in those later years dwarfs anything that happened early on, but it would not have been possible without those quiet, seemingly unproductive early years. Your investments work exactly the same way. The early years will feel slow. You will look at your account and wonder if you are making any progress at all. You will be tempted to do something, to trade more actively, to chase higher returns, to find a faster path. But the fastest path is actually the slow path. The fastest path is patience. The fastest path is letting compounding do its work without interruption. I want to be clear about something. When I say that turning $1,000 into $100,000 is possible, I am not promising you specific results. Markets fluctuate. Returns vary. Some decades will be better than others. What I am telling you is that the mathematical and historical foundations for this kind of growth are sound. I am telling you that the principles of patient, long-term investing have been proven over generations. And I'm telling you that the single biggest factor determining whether you achieve this kind of result is not market performance. It is your behavior. It is your ability to stay calm, stay invested, and stay patient. Over time, this matters far more than people realize. The difference between an investor who earns 8% annually and one who earns 10% might seem small, but over 40 years, that 2% difference compounds into an enormous gap. The 10% investor ends up with nearly twice as much money. And the most common reason investors underperform is not bad luck or poor stock selection, it is behavior. It is buying and selling at the wrong times. It is letting emotions drive decisions. It is abandoning a sound strategy because of temporary discomfort. So what is the secret, really, to turning $1,000 into $100,000? There is no secret. There is only discipline. There is only patience. There is only the willingness to think long-term in a world obsessed with short-term results. There is only the understanding that the market is there to serve you, not to instruct you. There is only the commitment to own wonderful businesses and let time do the work. I have been investing for over 80 years now. I bought my first stock when I was 11 years old, and I have often said that I started too late. I have seen fortunes made and lost. I have seen brilliant people go bankrupt because they could not control their emotions. I have seen ordinary people build extraordinary wealth because they stayed the course. And the single common thread among those who succeeded is patience. They understood that investing is not a sprint. It is not even a marathon. It is a lifelong journey that rewards those who can think in decades rather than days. As I close, I want to leave you with this thought. Somewhere out there right now, there is a young person with $1,000 who is wondering if it is worth investing. They are looking at their small sum and comparing it to the vast wealth they see others accumulating. They are feeling like they are too far behind to ever catch up, and they are wrong. They have something more valuable than any amount of money. They have time. And if they use that time wisely, if they invest consistently, if they stay patient, if they ignore the noise and focus on the long term, they have every chance to build real, lasting wealth. The journey from 1,000 to 100,000 is not a quick one. It is not an exciting one. It will not generate any headlines or make you feel like a genius, but it is a proven one. It has worked for generations of investors who understood that true wealth is not created through cleverness or timing or luck. It is created through the quiet, steady, unstoppable power of compounding applied over time. That is the secret that is not really a secret at all. It is there for anyone willing to embrace it. Time is the friend of the wonderful business, and it can be your friend too. The only question is whether you will let it.